Hello everyone, and welcome to our weekly market alert video for today, which is May 9, 2025. And we have a lot to get into with you, not the least of which is, why is the market up when we've got bad GDP? The labor market is cooling. Consumer confidence is falling significantly. Even the Federal Reserve is saying they're not going to lower interest rates because they're worried about inflation and a slowing economy. And we've got the tariffs. What the heck? So we're going to dive into all of that. And if you're wondering about our backdrop, we are in the beautiful U.S. territory of Puerto Rico, where they have the very Rico rum. And have to admit, we have tasted it for you just to make sure it's good. We're getting the rum for you so that you don't have to, as we always do everything like that. So we have a lot to cover, so thank you for watching. I've got Jordan here with me, our Chief Investment Officer. And Jordan, what is up with that? Let's start with the GDP. The GDP was down a lot, right? First time in 4 years or something. Right. And yet the market went down on that news, but the second half of the day was up. What happened there?
Yeah, I think it's when you look inside the numbers that make GDP. So you have a print that comes out and it looks bad, and you dive into, well, what is GDP? Well, it's gross domestic product. It's about what we produce, what we buy, what we sell. Well, the interesting thing is, as we've talked about tariffs in these last videos, a lot of companies are worried about it too. And so what they're doing to get ahead of, Liberation Day is they're buying up goods, buying up manufacturing goods, buying up product early. Well, that's actually a subtraction against GDP.
So companies buying a lot of stuff and bringing it all ahead of the tariffs lowered our GDP.
That's right. Isn't that amazing?
That's bizarre. Why? I didn't understand that.
So an import's a negative. We do not produce it, so it counts against. We have to buy it from somebody else.
Right.
That's right.
So it's actually a good thing, not a bad thing. The market went up. Okay.
That's right.
So now the labor market is cooling, right? We got the labor jobs numbers and unemployment and all of that. Numbers are getting lower. Market goes up. What's up with that?
Well, I think it's a couple things. I think one thing is, the market's always looking at, is it bad in and of itself or relative to what it thought? And the reality is, over the last couple years, we've had pretty max employment, fully engaged. And so the longer at max employment, the longer we are in that state, I think the market knows at some point it's going to tick up. So it's more about, well, how bad is this going to tick up? So we have a little softness there, but I don't think the market saw anything there that it was concerned about.
Okay, so now we go to consumer confidence. Fell significantly, but yet retail sales didn't.
Right.
So people are saying, I'm scared, the sky's falling, and because of that, I need some retail therapy. I'm going to go buy some stuff.
That's right. They're still spending U.S. dollars, right? So that's what do we think, what do we say versus what are we doing? And still, in what we're doing is we're not acting like we're scared, even though we're thinking maybe we are.
Yeah. So it's funny, consumers. Okay. So now let's talk about the Fed, the 800-pound gorilla in the room. They came out. They said, no, we're not going to do anything with interest rates because we don't know, too much uncertainty with tariffs and everything else. We're going to sit on our hands. Mm-hmm. But yet the market is still saying, the odds are that by the end of this year, 1-2 rate cuts are still in the cards.
Right. I think, the Fed's still has a very tough job. They have two mandates, which is effectively, keep inflation under control. The second being keep jobs healthy, keep growth. And it was clear from kind of what Powell is saying is right now, before we really know the impacts of tariffs, their main concern is inflation. And with inflation still a little bit higher than they like, with the maybe expectation that it could bump up, depending on all tariff negotiations, they're saying we're holding tight and we're going to wait for data to come through.
So, we're talking about all these terrible things, and yet the market's up.
Right.
But it is possible. I saw an interview with the director of the LA Port Authority.
Okay.
And he said that 65% of the shipments that they normally see in the LA port are still sitting over in China. And he said it's very possible, if this thing goes out another 2 or 3 weeks, that we'll start seeing empty shelves in the United States. And he was talking also about small businesses. I think 90% of all the shoes that are sold in this country are made in China, right? And so all these small shops, these retail shops that sell shoes, they're going to run out of inventory. They may not have the staying power. It's very possible. I mean, it's a likelihood more than zero that we could retest the lows or worse, right?
Absolutely. I think right now, as of right now, the market has looked past, like the worst case scenario has kind of been temporarily taken off the table, right? We've kind of gone reciprocal tariffs, then we had a pause, and now we've gone a UK deal. So, some of those really big fears that caused initial shock, the drop, have been put off the table. But now we could get to where the market could be surprised if we have a standstill where we cannot get goods across, right? And we have a lot of raw materials, goods that are produced by China, and then that would affect spending, that would affect compressed earnings. Then the market very likely could test lows or even blow through them, because we have not actually seen a material effect to earnings. We have not seen a material slowdown in spending yet, but that could lead to all of it.
Yeah, the example I always use is a boxing analogy, and what knocks the boxer out is the punch that he didn't see coming. You can see these two guys, they're wailing on each other. I mean, they're beating each other to a pulp, and neither one of them gets knocked out because they see every punch coming.
Right.
And even though it hurts, they brace for it.
Yes.
But the one that they don't see, that's the one that puts them on the mat right away.
That's right.
Think Muhammad Ali and Sonny Liston. I mean, some people even think that punch didn't happen, right?
Right.
And that's what happens with the market too. Like in 2007, when suddenly Lehman showed up, wow, where'd that come from? Bam, that knocked the market down. For a loop, the pandemic. So these sudden shock surprises, and right now the sudden shock surprise to me seems to be that the market is not pricing it at all. The possibility of empty shelves, that we suddenly have businesses going under because the negotiations with China are not going well and egos are getting in the way.
That's exactly right. And that would be the scenario the market yet has not had to brace for yet. But it might be put on the table depending how conversations go in the next few weeks with China. But that's right.
And so for that reason, how do you feel about the fact that we're defensive right now? In terms of someone who is not a client of ours, what would you suggest to them in terms of what we're doing? We're not giving advice. We're just saying this is what we're doing. And so if you wanted to become a client, we could do it for you. But if you're not, maybe you want to emulate us.
Yeah, I mean, I think we've had a lot of questions internally of honestly wanting to chase up days because people are so excited that, okay, this is going to be past us and we're going to get a tax deal and it's going to go up. We're ready. It's braced. But I think discounting how we could get worse before we get better, truly, I think that's probably a misstep because there's still plenty of risk right now that the market does not have to price in.
Yeah. And it could get, we don't think so. We're in the camp that we're going to play through this. But we always believe that you plan for the worst.
Yes.
You defend against the worst case scenario, and that way, if it happens, you're still okay. But if it doesn't, maybe you're not as well off as you would have been. But we're always, growth is important, but protection of principal is even more important.
Absolutely.
If our clients want to retire, or if they are already retired, we want to make sure that they don't take major losses that causes them to not enjoy the lifestyle they want or retire when they want to.
Yes.
So right now, our posture is, we're not out of the woods yet.
Right.
Be defensive. Don't chase these things. When you see these big rallies, don't think it's over yet, because until it's over, as they say, it ain't over until it's over.
We have a lot around the corner with talks. We got another Fed meeting next month. We were going to be in earnings season. So plenty on the table here that we're not going to be, just stepping past and thinking it's all over.
Yeah. Okay. So, ladies and gentlemen, thank you for watching. If you would like to, please visit with one of our retirement planners. We'll build an entire retirement plan for you. We'll go over our invest and protect strategy and the reason why we're playing defensive now. It's the same strategy that told us to sell in November of 2007 before the stock market crash of 08 and told us to stay out literally for almost a year and a half during the whole credit crisis time. Our goal is to protect your retirement, allow you to retire when you want, allow you to enjoy the lifestyle that you want once you are retired, and all of that means that growth is important, but protecting principles got to be your number one priority. So thank you for watching. Please like and subscribe the video. Visit with us, and we'll talk soon.
Retirement Planners of America.